Pre-market is, I like to trade those days when there's a PAL speech, when there's FOMC. I like to trade early in the day because the price action tends to be a little bit more cleaner. And what I mean by cleaner, it's a little bit more obvious in terms of what it wants to reach for. It's far less likely to be like a seek and destroy or a high resistance liquidity profile, because there's a lot of professionals in the market trying to get in and take something early on and let everyone else gamble after or during or ahead of a PAL speech. Typically, the days that have the Fed chair speaking, right before he starts, or she, when there was a lady that used to be a Fed chair, whenever they would speak, leading up to that, the market would tend to be a little bit more fickle, a little bit more challenging. And in my opinion, they were better left to the novice traders, someone that just wants to believe they can gamble and get lucky. But on days that your Fed chair is speaking, and it's in the afternoon, or if it's really early, like say it's like a 10 o'clock, or even a 9:30 or 9:15 or 9:45 speech, anything, okay, prior to 9 o'clock, in my opinion, is pre-market, because the opening range is 9:30 to 10 o'clock during that first 30 minutes of trading. If there's a Fed chairman testimony where they're talking, any time within that 9 o'clock to 10 o'clock hour, you want to be trading before 8 o'clock in the morning. So you want to have that in your notes. Today, if you look at the economic calendar, you'll notice that there is one medium impact news event. That's the Chicago PMI number at 9:45. So that's 15 minutes after the opening bell. So that's fine. That'll help fuel some of the first 30 minutes trading. My counsel to my son is, because it's a 9:45 medium impact news driver, he has to sit still and wait until 10 o'clock. So he'll let that news driver come into the marketplace, let traders either get canceled out, stopped out, or get kicked into an idea based on what they see at the 9:45 news event. He's not trying to predict the delivery of price. He's letting that first 15 minutes pass. Okay, so that's like the minimum criteria for anything that comes after a high impact or a medium impact news driver. Wait 15 minutes. If you're trying to trade right on the release of that news and it's under 15 minutes, your chances are you're probably in a rush and you're in a hurry to do something you probably aren't equipped to trade with. There's plenty of other opportunities to get in, as you'll see in the rest of the mentorship before we close it down this year. There's lots of ways to get into a move. So the pre-market session is anything before 9 o'clock in the morning. We have a Fed chairman testimony today, but it's in the afternoon. So you can trade all the way up until the opening bell. 7 o'clock in the morning starts it, and that's 7 o'clock in the morning Eastern time. So whatever the local time is in New York, always have your clock set to that, and especially your trading view charts. Because if you don't have them toggled to New York time, if it's not toggled there, everything that I'm teaching, you're not going to be able to follow correctly. If you're using your local time, it won't work. So sitting down with the charts, this is what I do. Okay, this is exactly what I do on Sunday. So I deferred everything that I would normally do then. I'm doing it now. Now, admittedly, I'm doing it a little bit late because I want to come into the live stream knowing next to nothing in terms of a bias. I don't have any kind of preconceived ideas about what I want to see in the charts. I want to see what the chart looks like as I sit down with it. So this is basically pantomiming the closest thing I can. I can't forget what I already know, right? But for the sake of presenting it for my son, and also to try to illustrate that, it only takes a few minutes to ascertain what it is that you want to focus on. And now we're going to go through it. So this gap up here, we talked about this throughout the 2024 mentorship. We talked about the volume imbalance here. In the September contract, I told you that was about as far as I could see for the year for that contract. It went just a little bit above that, and then when we rolled over. If we looked at the on the daily chart, right now I'm looking at the weekly, but the weekly has this imbalance up here. So we've had that trade too. and we have just a few more weeks to get to the US election. And I want to give the market the opportunity to explore lower prices. And what would that look like? Well, we already have what would be the start of a potential, I'm not saying that it is, this could be a potential turning point. So I would like to see if we can make an attempt to start breaking down. I don't want to predict or time the high in the marketplace, but I'm affording myself at least going in, because I'm assuming that it's a Sunday. The weekend's passed, and now I'm going to look at what I want to try to see in price action, formulate some kind of a game plan. I like the idea of entertaining the likelihood of trading down into this gap here this week. So that's this right here. So basically what I'm doing, I'm giving you a soup to nuts breakdown of what I do on the weekend. Sometimes I'll do it on a Friday, and then I'll have notes about what I expect to see based on a higher opening on Sunday's gap, or a lower opening gap, or a lack of a gap. So I'll flesh out scenarios, and I'll talk more about that in the book, because it's not important. Right now I'm giving you actionable points. That's this whole week. I'm giving you something to strip it down, remove all of the moving parts, and say, okay, I need something to provide myself a way of determining a bias. And then I have to also learn how to frame a narrative why the market should behave a certain way. And then what model am I going to use? And what time of day am I going to trade? And how am I going to enter the trade? And how will I place my stop loss? How will I take a first partial? When will I move my stop loss? When will I be content and it trades to my terminus, and then I stop trading for that session or that day and then go back in the next day? That's what we're doing this week. Like, this is boot camp for getting out there and using my concepts correctly, streamlined. It's not fluffed up with everything you possibly learn from my YouTube channel. It's literally going in and saying, this is how you make money. This is how you go in and you look for setups that form every single day. You go in looking for this same repeating recipe. Sometimes it isn't going to give it to you. Sometimes you'll think it's there, you'll execute on it, and you'll lose. That's the reality of it. I don't have a model that's 100%. I'm not going to teach you 100%. No one else is going to teach you 100% either. So just relax and accept the fact that uncertainty is something you need to embrace. But you can start to strip away some of that stuff by fleshing out a model that has sound logic in. And what we're looking at is, we're up here, we traded to a premium relative to the weekly chart last week, and then now we're in this week's present candlestick. The inefficiency on the weekly chart is this candle right here. This week's high, that week's low. This individual candlestick only has buy side delivery, that means movement higher. And it would be reasonable to anticipate the market wanting to go this low. Okay, and for annotation purposes, Caleb, what you want to do is, when you're annotating on a higher time frame chart, anything you put on your chart on a higher time frame, because you're going to be working on lower time frames for entries and exits and management of a trade, you want to annotate that. So this is September 23rd weekly low. So that when you go into the lower time frame charts, when this line appears over here on the right hand side towards the price axis of the chart, this is your time axis at the bottom, this will always give you a reference point as to what you're looking at. Because if you start laying down lines on your chart and you don't annotate them, you don't tell yourself what they are, they're meaningless then. They're distractions. So you want to be organized with your annotations, and then obviously if it makes the effort to get down into this inefficiency, this one here, September 9th. So the week of September 23rd and September 9th, respectively, shown here. And this is the weekly high for that week. Short, sweet, and easy. Now you can go as far as going into adding the consequent encroachment of that, and I'll do it now just to show you, Caleb. Take the low of it, and the high and the midpoint. Take the quadrants off. So 883.25. $883.25, $883.25. Okay, and just anchor it inside that candle there. You can label it. There it is. Okay. This wick here, you can annotate that with consequent encroachment as well, and this one. But we're going to leave that off today, but you can do that for your own charts. And then the daily chart. So now we can start refining a little bit more. We have this little gap in here of volume imbalance here and a volume imbalance there. Whenever there's consecutive volume imbalances with just one single candle like that, just do the entire range. It makes it very easy. You'll see the inefficiencies just the same as you would if you just done them individually. So what that looks like is this. And since it's a premium array, you want to have some kind of a hue. But we have that volume imbalance here. That is two consecutive volume balances, but only separated by one candlestick. Usually you only see something like this candle's body to that candlestick body, and that's a volume imbalance. But there's one immediately to the left of that too. So just encompass the entire range there. It's fine because this is actually an indecisive candle. It is basically all, but it's not that important. The more important factor is this and this. Okay, so just disregard this one. Trust me in that. Okay, you'll see what it means when we start looking at lower prices. All right, so now you should already notice that there is two lows down here that are real close to one another, right? So when we drop down to, I'm sorry, we're going to do a 60-minute chart now. Okay, and you see this big wick right here? This is a level. I'm literally teaching you right now. This is what I write on my notepad. You guys keep asking, keep asking, keep asking. I go through the charts and I write down all the things that I'm doing right here. Any wicks that are at lows or highs or in close proximity to market price, I annotate those consequent encroachment levels. And if it's something that's a discount, like this would be here relative to where we're at here, this is where the market price is right now. 20,152.5. Let me add the there you go. It bothers me when I don't see that thing there. This wick is lower than current market price. So that means that this is a discount wick, whereas something like this wick would be a premium wick because it's above current market price. This is another level here. I'm writing them down as we go. So this level here, okay, so that's consequent encroachment there, and this will be annotated as an hourly. I abbreviate, I just put like a 60M CE, and it's because it's lower, I put a little tiny D next to it, so it tells me it's a discount. So it's 60-minute. discount wick CE. That's your definition so that we understand what it is. Now, I go through the daily chart. I like the idea that we cleared this high here. I like the idea that we went into this inefficiency here. This is sell side and balance, buy side efficiency. I love the fact that we traded back up to change the state of delivery, which is my order block theory, and it's the opening price of the up close candle right here. So that is a really nice delivery there. And I don't know why every time I'm drawing these trend lines, it's shooting to the left. I have no idea why it's doing that. Yeah, I don't know what's going on there. It's weird. Let me know in Twitter if TradingView is acting wonky for you. But I don't want to do a ray because this is going to drive me nuts. It's not important. But that opening price there and this high, that being together is that's nice. What I want to see, admittedly already, is I want to see price try to go lower this morning. Okay, so my bias is bearish. I want to see something that I can frame as a narrative now to go lower. So what would that be? Well, we already noticed on the daily chart there were some relative equal lows that I spotted. But can we see them on the lower time frames where it makes sense? So we can drop down from the hourly chart now to a 15-minute time frame. So we'll drop down to an hourly chart to a 15-minute time frame. And here's the business from, here's Friday and then Sunday. So the only thing I did last night at 6 o'clock was annotate the weekly opening gap, and then I turned the charts off. So this is the first time I've seen a 15-minute time frame. And looking at the lows here, notice how that low has that lower low to the right of it, and then this low has that low lower than the one here, and this low has the lower low here to the right of it, and now this low has been breached by this. So we don't see any kind of relative equal lows here. We see what? The market keep probing lower, keep probing lower, keep probing lower. Remember what we have later in the afternoon, that Fed Chair Powell speaking. We have a little bit of likely volatility coming in, and then what we'll have is what? Some kind of a Judas swing, right? Between 9:45 and 10 o'clock in the morning. I'm anticipating in my mind, I'm thinking, okay, without that 9:45 news driver, the Chicago PMI news report, that's what I'm referring to. So if you look at your economic calendar, you can see that on forexfactory.com. We're now inside the 15-minute time frame. But when we get into a 15-minute time frame, this is when, if I am going to start looking at SMT, if I'm ever going to consider doing it, if I'm going to look at that, because the 15-minute time frame for Caleb and for the 15-minute time frame for myself, it's a bellwether time frame, meaning that I'm going to lean on a lot of information that this time frame gives me, because I can see 60-minute highs on a 15-minute chart. I can see a 4-hour high or a 4-hour low on a 15-minute time frame. I don't need those 60-minute charts. I don't need those 4-hour charts. I don't need a 2-hour chart. I don't need a 3-hour chart. I don't need a daily chart. I don't need a weekly chart. I can open up, just look at a 15-minute time frame, and I have everything I need to be a day trader. If I'm going to look at SMT, I would do it here. So just notice the lay of the land here. We have a slightly lower high here, higher high here, consecutive little higher highs in here, and then I would refer to ES. You can see the high is higher here now. When the NASDAQ, we didn't have that, so that's SMT. So NASDAQ at that time, since then, it's been weaker. Just remember these reference points here. This high is lower than this one. And now look at this. See this high here? This one's lower on ES than it is for what? NASDAQ. So S&P has an SMT divergence. This high doesn't make the same high that we see in NASDAQ. And watch when I toggle back. See? So that's why you're getting that x-ray view behind the scenes. But you would already know being short in this inefficiency is appropriate, because you have this lower high than this one relative to what we just saw on ES. So on my notepad, I just simply note the time that at 8 p.m. Sunday, which is during Asia last night, that there was an SMT divergence, 15-minute time frame, at 8 o'clock between NASDAQ and ES, and NASDAQ is the weaker. And you don't need the SMT divergence here to tell you to get into a trade, because you can see that that inefficiency there is what you'd be entering. You don't need to have any kind of SMT divergence to tell you that trade's good, because it's already there. What makes it good? Sell side, buy side, both taken. When we had a divergence back here showing you that the NASDAQ was weak. So we already have a built-in what? We have a built-in heaviness on NASDAQ. It's heavy. And this just so happened to be a little bit more aggressive just to get in here to offer a nice premium. What makes this a premium? Why is this wick right here, why is it a premium? Because if you look at the range from this candle's high down to this candle's low right there, I'm going to change the color so you can see it. And we draw it out over here. Is that wick above the middle center line? See these little outline squares here? That black line right there. That wick right here, that wick right there, that wick right there. Either of them could be short entries because you're in a premium. Because you're inside this inefficiency between this candle 1, candle 2, candle 3. The inefficiency is always candle number 2. Your stop, if it can be afforded to you, is always above candlestick number 2. But if there's small ranges like you're seeing here, you can use the candlestick number 3's. Body, if it has a wick, you can use consequent encroachment of that wick. Don't look at that range from where you'd be entering and think, okay, this is too big of a stop. I don't want to do that. You should always err on the side of what's my smallest risk. So we have the opening of Sunday's gap here. That's 6 p.m. and that's the settlement price on Friday. That's what these dashed lines are. That is simply just me annotating the weekly gap. So it's a new week opening gap. And now on the 15-minute time frame, I'm going to zoom out. Okay, I'm going to zoom out and take in more information. Oh, there's those daily relative equal lows. And look what is below it. We have the weekly buy side imbalance, sell side inefficiency. Remember, we were on the weekly chart. I said I think that we could explore going down into the very minimum, the high of that BISI on the weekly chart, which is the high, that blue shaded area. That's anchored on the weekly chart, but it just so happens to be inside of the same proximity of this low and that low. So what's resting right below here? Sell side liquidity. So we can now take sell side liquidity below these relative equal lows. And now with September 23rd's weekly low, you now can state also in there that it is also 15-minute time frame, relative equal lows, sell side. All right. So now, screenshotting this because you can see where the reference point is, and then going back over to where price is now. We have a little inefficiency right now we're trading up into, and we're also inside of another inefficiency that's being shown. I made the mistake because I'm talking. When you draw your inefficiencies, you want to annotate them as well. This small little inefficiency in here so we have a SIBI here, sell side imbalance, buy side inefficiency, and we have the 60-minute discount wick consequent encroachment. That means on an hourly chart, that big long wick that went lower, that made a swing low at, that's half of that wick. So in my mind, before we drop down to a lower 5-minute chart now, in my mind, I'm anticipating a run to this level. It might want to go down below it, come back up, dilly-dally around that consequent encroachment level, worst case scenario, and then dive into the sell side, resting around that 19,953 level. Okay, so I anticipate that happening. I am not imposing my will on the market. I'm not saying it has to happen because I want this to happen. I wrote these things on my chart, so therefore it has to happen. No, the market has to indicate that it wants to do that. It needs to do certain things, and we're going to look at that today, okay? But up till now, this is my pre-market analysis approach. This is all it is. Is it complicated? No. I did more talking about other things, probably pissed a lot of you off, but it's a matter of simply doing what I just did here. Looking for reference points from the higher time frame weekly chart, because you're going to have to refer to where are we at, where could it be reaching for the weekly chart? Because if you don't refer to that, you're going to hide all of these really big runs that might jump out at you unaware. A sustained price run is going to unfold if the weekly chart, if the monthly chart is indicating that it's likely to go to any given higher or lower price. But if you're framing your trade on the basis of just a 15-minute time frame and that's all you do, if that's all you do, you won't have the perspective that's required to capture these big monster several hundred handle runs, even if you are not a swing trader or a short-term trader. But wouldn't it make sense if you could just go into the chart one time at the beginning of the week, say, okay, here's the lay of the land, this is what could happen, and at least have it on your chart. The point is, my question was, if it dropped sharply and was trading right about here, would it be easy at that time for you to submit to the idea that it's probably going to trade down to that mid-wick level on the hourly chart? And if it went through that, wouldn't it be reasonable to see it trade down into these relative equal lows because they're really smooth, right? Can you see how price could work from this level here? Not at that level specifically, but in this general region, because we have an inefficiency that's shaded there. Can you see how it can move from this one to the blue one? Can you visually see how that could be delivered? Because if you can't see that, that's going to be problematic for your trading, because you have to be able to see your setups. Before they're there, you have to be able to see how that could pan out. And that's an experience-driven thing. It's not something that you're going to be able to see the first time, Caleb. It's the ability to see the potential, how it could deliver from this inefficiency down to that one. It makes sense that it could do that. And it need not be an overall reversal long-term and still see this deliver like that. It could go down here and upset this here and then create some important low and make a higher high and go to all-time highs. Don't think that we're trying to predict, or that I'm trying to sell the idea that I'm predicting the top in the market. I'm not trying to do that. All I'm doing is I'm framing, this is a best case scenario. This is how I frame it in my mind, okay? When I go through my first analysis for the week and my pre-market analysis, I'm looking for things that I can hang my hat on and say, okay, push comes to shove, I am going to submit myself to this above anything else. But if I don't have something that allows me to get in a trade like this, then I'm going to trade with less leverage when I'm taking longs. Now let's go down into a lower time frame. 5-minute chart. All right, so we're looking at a 5-minute chart with the new week opening gap. That's what that purple dashed lines are. But looking at this chart, if I'm wrong, I do believe that we're going to get down here, like based on what we have right now. What changes that? What makes me put that idea on the sidelines for a little while until something gets back in favor of it? Because I'm not infallible. I have to have a contingency plan. If this is what I'm looking for, if I want to see price trade down there, and I'm only interested in taking that type of trade, then what am I doing? I'm imposing my will, and I'm teaching you not to do that. The algorithm is just the price engine that delivers price up and down and goes to these points of reference for the purpose of trading to engage the liquidity or reprice to inefficiencies. That's the only things that happen algorithmically. If it's not being delivered that way, then manual intervention comes in, and then you see what we saw like last week. Or FMC, or like when Powell starts talking today, that's absolutely 100% manual intervention. That's why you should not be doing anything while he's talking. And for 15 minutes after he stops talking, start looking in price and looking at my PD arrays, and when they start booking perfectly to the tick, that means everything went back to algorithmic delivery. Today's Monday of non-farm payroll. I am always trading on that Monday. I'm always trading on the Monday of non-farm payroll. I tell everyone that's a new student to just sit still on Mondays outside of non-farm payroll, because they usually use that day to set the initial parameters for the weekly range. And you might get chopped up. You might have a winning trade, but you hold on to it too long and it turns against you. Or you're doing it wrong because you just don't know what you're doing. So that's why I tell new students, don't trade on Mondays and start their trading on Tuesday. Their active participation, and say it that way. So because it's Monday of non-farm payroll, and we have Fed chair talking this afternoon, we want to be able to find our setup within the first hour of trading. So that means 9:30 to 10:30. In that 1 hour interval, if you can't find your setup then, don't do anything. Just simply sit still and don't do anything, okay? Because the closer we get to Fed chair talking later on in the afternoon, the closer we get to the afternoon lunch hour, which is technically 2 hours, it's 11:30 to 1:30 p.m., the more likely that you're going to get slapped around and you'll get beat up. So you have to have a limit in terms of the time that you're willing to do something on the day that the Fed chairman is going to be talking. When they're talking, and just before they're talking, the hand comes in, the manual intervention, the thing that you don't expect to see in price. And if you're in there, you're probably going to get crushed. You're probably going to get stopped out. You're probably going to get scared out of your trade. Everything that would go wrong, that could go wrong, is going to happen. So don't be in the marketplace then. We're in a 5-minute chart. We have our inefficiency here. We're going to drop down into a 1-minute chart. What I'm watching here is see how the bodies are just hanging around the middle of this inefficiency. 9:30. Let's take a look at the. So we have a discount gap that could trade up into here. I know, it's an ugly color. All right, so we're in the lower quadrant of that opening range gap. I was saying earlier, and I didn't get a chance to say because I was discussing other things. If I was wrong about it going down into the weekly imbalance and that hourly discount wick, it may want to come up and take buy side out. So it could take a pass through. This is assuming I'm wrong. It could trade above that and really entice people to think it's going to go higher. And then I'd have to wait for it to break down again and get down below whatever first fair value gap that forms in the 1 minute chart, which is yet to form. But any setup, the entry would have to be in the first hour trading, so between 9:30 and 10:30. And if there's no entry, there's no trade. The buy side has been ran here. So we went above the opening range gap relative to last Friday's settlement to today's open. That's what that yellow box is. Any of this run here, I'm not interested in any of that. If it keeps on going higher, it simply means it's going to do it without me. Top of that inefficiency that's shaded here, this one, that low shaded area to that high shaded area. It could come up here and hit that. If it's going to go there, it would make sense for it to wick above, take the liquidity out here. Otherwise, it would need to stop with the bodies in the upper quadrant of it, right about where it's at, and then roll over. Anything that's shown here right now, I'm not interested in any of that. Just want to take a quick look at ES and comparison. All right, you can see what ES can do, right? Right here. There's your buy side. So it might be trying to get up here to disrupt this. So for ES, we can monitor this one, because it does definitely have a draw on liquidity there. Take a look at Dow. Look at Dow. So what we're seeing here is the decoupling. Decoupling is when all three averages are doing something different. This drop down is not seen in NASDAQ. It's not seen in ES. Let's go back to ES. See that? So I would expect them to come up here and disrupt this. They don't have to, but it would be much more meaningful if they hit it and then started to sell off. That means they took out these individuals here. If they take them out, what are they doing it for? They're taking them out to take their stops, and they're going to sell short against those buy stops. So anyone that's short, they have their protected buy stop right above here. So it's reasonable to anticipate the market want to go up there. What would be the narrative for that? Well, if it goes higher on the day, it goes without saying that that would be a nice area for them to take partial profits and lock in something profitably. But I like the idea of it going there to see if it can unseat these individuals. They don't get to have the profit here. It's being taken from them. And then if it sells off from there and it starts to build in technicals that would send us down to that sell side, that's the idea, and that's the side of the market I want to be on. This is all just me watching and monitoring and just, yeah, okay, we're tape reading it. I'm not in it. I don't want to trade it long in there. We can, but I'm not interested in it. I want to see what we do when we get there. Add to it that we have the indices not agreeing. So the only element of Dow theory that I do use, okay, is I like the idea, if I'm bearish, I want to see all three averages moving in the same direction. That's simple, okay? But I don't see that here today, neither do you. The Dow has dropped. The NASDAQ has gone higher. Well, let's go back to it real quick. The S&P is obviously doing what you see it doing here. So this is a decoupled. Actually, this is watch them hit the stops first. Then we'll go to NASDAQ. Whenever you're trading, looking for a setup, or when you're in a trade setup, you want to see all three averages agree. That means if you're bearish and you're in a short, even though I don't like the Dow, because there's only 30 stocks and it's a little unruly, that's why it's called the dirty 30. The impact on its movement by and of itself is not all that important, but it is usually sometimes the canary in the coal mine, where if we see the Dow just saying, nah, I'm not doing something that you other two are doing, that may be indicative of something changing. Not all the time. But if I do see a divergence between the NASDAQ and the S&P, and they're not doing the same thing, that's clearly a time when you don't want to be trading, because you're in a decoupled condition, and you're most likely playing in a sandbox where manual intervention is about to happen. You're going to have sand kicked in your face. You're not going to be able to see what you're doing. You're going to lose visibility, and you're going to lose money. And if you lose control of yourself, you'll wreck yourself, go on tilt, and blow your account. So long story short, you want to have a day or a session when you're trading where all three averages are agreeing. So we'll cycle through. We just went right back to the same high. I think they're going to still go up and hit that, but let's look at NASDAQ. Okay, so we took out the highs. We ran over here and took the high out over here. I told you if it was going to go to the high, that shaded area, it'd be reasonable to anticipate them blowing out the stops above here, which we've just seen them do that. There. See that? So I would want to see it. Unfortunately, it's probably going to have to hang around up here until ES completes its rotation for buy side here. I mean, it would be highly unlikely for it to leave it like that and just start to drop. And now watch with the Dow. Are they all agreeing? No. So how can you feel comfortable sitting on the sidelines and that you don't have a trade on right now when the market looks like this? All three, in a perfect world, when there is symmetry, this is not a symmetrical market. A symmetrical market is where all three averages are moving in the same direction. This is saying, I'm not even going up there. I'm going to go lower. Which to me, I'm taking that based on what I've already did as in the pre-market analysis, that this is the canary in the coal mine. It's saying that there's something wrong with this. Let's go back and look at the other indices. Here's the S&P, and here is the NASDAQ. So I would like to see NASDAQ just stay here, hold it like a bull flag formation, let everybody anticipate it breaking higher, and then a sharp breakdown lower, and then inside the opening range gap, treat the midpoint. Once it gets below that, treat that midpoint as a premium, and then sell off from there and displace. But we have the very first fair value gap here on the 1 minute chart is at 931. It's rather large there. And this is all ahead of the Chicago PMI too, by the way. That comes out in less than 4 minutes. I take this as them fluffing up the market, stopping out any individuals that were short, and then they may elect to take the market down sharply into our objectives here on the day or going into tomorrow. That's kind of like what I internalize. I say, look at the Dow. This is garbage. That would annoy me, to be honest with you. If they just dropped it from there, that would absolutely annoy me. But it would mean that we're probably going to have to come up there later on, which would be fine, right? If they're going to take it all the way down to our NASDAQ objective, they're leaving what up here then? Buy side. So coming all the way down to that deep discount on NASDAQ and dropping ES and sympathy with it, this would be where the market would draw to on the upside if it goes down there. Down where? Down there. So looks like we're trying to build in that pseudo bull flag thing. So right away you can see how and why I don't keep all this stuff on my chart, because to me it's absolutely distracting. But I have to have these things framed out for you to understand what I'm looking at. So if I'm holding an opinion around certain key levels, what are they based on? Well, everything I've outlined here. All right, 30 seconds to Chicago PMI number. 10 seconds. We'll see some volatility. This is a medium impact news driver, so it's not red, but it's inside that first 30 minutes opening range, so that can tend to be a little bit more animated than normal. We really should be looking at ES, Michael. See if they run those relative equal highs. No matter what price is doing in this environment, because there's a decoupling between all three averages, that gives me a confidence to sit still. If every average was moving in the same direction, I would feel like they were probably going to take it higher and continuously move higher. But because the Dow, it went down when the other two averages, the NASDAQ and the ES, went up. ES has unfinished business here in the form of buy side. So that's the holdup for anything going short for me. I want to see it go here, disrupt these relative equal highs, and then see how we trade after it does that. And I would like to see it move lower sharply after it goes there. So I'm sitting here, I'm waiting for certain criteria to be met to frame the idea around the narrative I already outlined this morning. We have a few clues that might be in play, but we still have to work through the effects of the Chicago PMI. Not that the data itself is moving price. They use these high impact or medium impact news drivers. They use these as smoke screens, basically, is what I'm getting at. Like it's easy to justify on the news, oh yeah, the market had a so-and-so rally to blah, 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 because of the Chicago PMI number. The market's not reacting off of the number. The market's going to go to where it needs to go. In this case, it's going to go to where the stops are. A perfect world, a perfect trade setup, All three averages are going to move together. That's Dow theory. That's the only extent of Dow theory that I have. That's it. I want to see the averages confirm. All right, looks like we could make a attempt to get up here. Finally work those levels out. Let's take a quick look at Dow real quick. Yeah, still ugly. Okay, see what it's doing? It's just hanging around. I like that. I like this. To me, I view this as it's got to look like it's trying to be bullish to allow ES to do its damage on those relative equal highs. That's how I see this. This right here, just it's ugly. It's really, really ugly. That's exactly what I was telling you. So it's going to hang around in like this bull flag type formation where people are going to want to see it go higher. They want this to break out to the upside. Retail traders want to buy this. They want to be long in this, especially after seeing all this shit. So by having ES with its unfinished business up here, here's what's happening. Phil's watching my live stream this morning. And he's like, I'm going to fuck with you today, ICT. We're going to sit here and just hammer that. It's okay. It's okay. I'm still going to make money today. I'm still going to make money today. It don't have to be in this stream, bro. But we're waiting for the green light after the buy side's taken here. Mm-hmm. So where it's at right now, that volume imbalance, that should be the end of it. If it's going to go up there, it should be done here and it should start to move up. If not, it's going to break below here, and then we'll start seeing the NASDAQ move in sympathy with that of the Dow. Look at the Dow. It's just staying down on its lows. So whenever you see this decoupling, every price run, whether you're trading the ES or if you're trading the NASDAQ, I guess for the folks that are just nuts and want to trade the 30-30, if you want to trade this in this indice here, the Dow, look what it's doing. Would you want to trade this when the NASDAQ and the S&P are going up? So I'm kind of giving you the flipped perspective of it. Say you are predominantly a Dow trader. Would you want to be trading this indice if it's doing this against the two higher composite indices, which is the NASDAQ, which uses 100 stocks to make that composite index. And then you have the S&P 500, which uses 500 individual stocks to make up its composite. So if both of those are going higher and this one's going down lower, what does that mean for you as a Dow trader? It's still decoupled, right? So they should be moving in agreement and sympathy one another. All three should be going up if they're bullish, and all three should be moving down when they're bearish. If there is ever a time when that is not true, like we see here this morning, that is a sit still and wait. You have plenty of time in the rest of the day. You have plenty of time. You still have the Powell speech later today, which is inviting this very event here, decoupling. A lot of people there's not a lot of big money movement right now. They're just moving price around. After Powell's done talking, 15 minutes after that, you're going to see very nice, clean price action. But are you willing to wait for that? Most people aren't. Okay, and we overshot that volume imbalance by a little bit into the gap here. I'm watching the bodies in here in respect to this gap in here. Look at that gap I was telling you there. Boom. And then let's go take a look at the Dow real quick. Pulling up into its gap right there. It's a little smooth, I guess, on the upside, isn't it? They might want to pop that with ES. But you can see how much more complicated. This is a complex market to trade in this morning because you have each indice doing its own thing. And it's real hard to frame low risk in that environment. You can see what it's likely to do, but is it worth putting your money behind it? All right, so we're inside the new week opening gap here. And it's also consequent encroachment of the opening range gap. That's what that yellow box is. So in a perfect world, it would want to drive into this sell side here. This gap as it was trading up into that. I was telling you, watch that gap right there. And she was very, very useful there. It's very close to the high of that imbalance that's shaded in purple, or whatever shade that closest to purple is here. Now in that yellow box, what can happen, and I would like to see happen, is for it to drop down, stay inside this red box, come back up and touch the bottom of the yellow box. And if it leaves that volume imbalance, come back up and reprice to that volume imbalance between this candle's here and here. Hit that and then rotate lower. But it may not do that. It may just take off rolling. Either way, it's fine. I told you I wanted to see it go to here, but I'd like to see it use the opening range gap low that this yellow box represents. I don't want to see it deliver like that though. It needs to be a separate candle. In other words, if the candle would have been down here and stopped and created a new candle and trade up to it, any type of return back to a premium array, you want to see it do that. You don't want to look at it on the same candlestick where it moves away from the PD array and comes back to it in the same. That's never what you want to see. That's never, ever, ever a point of entry for you to use it like that. It needs to create a new candlestick and trade up into it. Then expect it to roll over. This is what you get by just reaching into these little lows here and back inside the opening range. So let's take a quick look at ES once more. This is the benefit of having multiple screens, by the way, or dividing your screen. But I want to keep one big chart on the screen as I talk. Now think about what you've learned so far this year. And just in the last 8 weeks, you've learned how to identify high resistance liquidity profiles. You've learned about seek and destroy and how to anticipate them and see what it looks like real time to identify it. You've seen an episode here now with decoupling. And how do we anticipate decoupling? Whenever there's a Fed chair speech, FOMC, those types of things cause decoupling. Everything just unravels. And that's why you have to wait 15 minutes after he's done talking to allow for things to try to get back in sync. And they may not get in sync in the first 15 minutes after he's done talking, but you wait until they do. If you don't see that, you sit on your hands. Yes. It gives you a peace of mind. I mean, look at the ES. That's oh, that would make me mad. if I was in that, man, I'd be like, hey, come on, what are you doing to me? And NASDAQ is rolling back down outside of the opening range gap. So same thing I was outlining here. I'd like to see it trade down in the lower portion of that pink box, create a new candle without leaving or going below this low here, create a new candlestick, come up and trade up into the low and or the lower quadrant of this yellow box. Because we went back up and did what? Traded back into the new week opening gap, repriced to the volume imbalance right in here between these two candles bodies and here. So the only market that's doing what we would want to see happen in price action is the NASDAQ. You see that? So the symmetry in the market as a whole is broken, but we are able to see price cleaner on this one than we can see it on the Dow and or the ES. Now again, I don't want to see it just go below these relative equal lows. I don't want to see it go down there a little bit and then come right back up into this yellow box. That's not something I want to see. All right, so NASDAQ should get some movement lower. So we're leaving those 3 highs up there in ES. So that bolsters the idea of if NASDAQ can get down to where we were outlining this morning, they might be onboarding longs there and then come up higher later on. Not necessarily today, but later on in the week it might be revisited. So not bad. The key takeaway, Caleb, so far is we were able to see that gap right there could be used, and we've been framing the idea that we want to see NASDAQ go down, not go up. So we've seen the market trade lower. We had a swing low in here that was pierced there. So you have a shift in market structure. Fair value gap trades up into it beautifully. We were calling the fair value gap before it traded up there. So I said, watch it. So you'll see it in the stream. You'll be able to rewind it. In fact, you probably still should be able to rewind it now, but you shouldn't be rewinding anything while I'm talking, because you're going to lose some kind of information that I'm talking about live. But then we delivered nicely off of that. And then we traded down to half of the first presented fair value gap, which is this candlestick here. So in fairness, it looks like this. And again, this is why I don't draw everything on the chart that I'm referring to, because look how much is already on the chart. It makes it complicated if I do it this way, but I have to draw them so that way you can see what my eye is keyed up on. And I'm looking at it in this perspective, but I don't need it to be on the chart. And I'll show you what I mean by that. This candlestick's low, and the down close candle here's high. That is this shaded area here. Okay, so this, I just might as well tuck it in here too. If we're bearish, which was what we've been focusing on for NASDAQ today, we're not interested in being a buyer. It can go up and not have any interest for us. I'm not interested in it. I want to see the sell-off. I want to see the short side of it. So if the first presented fair value gap here at 931, which is the earliest it can form based on what I'm giving Caleb as a model, if I'm bearish, and this is the fair value gap that we're going to focus on, how would this candlestick be used? As an inversion fair value gap. Now, I'm saying it slowly and carefully because I want to make sure that I correct myself, because I did something incorrect last week in stream. I said something incorrectly, and then because I heard myself say it and I was live streaming, I kept going back to calling it the same thing incorrectly. And it was based on me drawing on the chart, and it disorients me. So when you're bearish on the market, up close candles that make a fair value gap, which is a buy side imbalance, sell side inefficiency, is going to be a bearish inversion fair value gap. So if we go down like we do here, we went to consequent encroachment of that gap, which let me shade it with the little horizontal thing with in here. Make it bold. So we've been bearish. The market used the fair value gap I outlined before it went into it, trades lower, trades down into and away from, see the orange shaded area here, this box? We left it, came back up, went right to consequent encroachment to the tick, right to the tick. Then it behaves as an inversion fair value gap, lower. If at any time after it delivers on the basis like it's done here, it's reacted and left it and took out a low, that is already done enough to afford it as a properly classified inversion fair value gap. It does not need to trade down the sell side here. It does not need to go down to the target I outlined today. It offered a trade to take out the sell side that would be resting right below that low here. From consequent encroachment to that low, that's a setup. If we ever trade back above and back into this fair value gap and come back down into it, this would be classified as a reclaimed bullish fair value gap because it's an up close candle. That's how you classify it. I made the mistake of calling it an inversion fair value gap last week when it wasn't so. It should have been called a reclaimed bullish fair value gap. So I made a mistake last week in my stream. And it's because I got disoriented by drawing on the chart. I know what I'm looking for. If you go back and listen to what I was describing, you'll hear me describing what I see price do with that range. And I just mislabeled it by the name. But what I was expecting to see price do around it is what was accurate. But I did make a mistake and call it inversion fair value gap when it should have been reclaimed fair value gap. So again, even in a sloppy, disjointed, decoupled market where the ES is doing this and the Dow is doing that, our market, we did pre-market analysis on, and all the PD arrays are delivering. Fair value gap, I told you we were going to consolidate around up in here. Perfect. I told you retail is going to want it to go higher. Well, what am I doing? I'm arm wrestling retail with smart money concepts. Smart money traders are shorting up here, accumulating these positions, Then we have a displacement lower at the fair value gap. We were down here. I told you, watch this fair value gap here. Trades up into it perfectly, drops down. First fair value gap here. It's a buy side of sell side efficiency when we're bearish, meaning what? It's going to be used as an inversion fair value gap. Once it trades out of it, comes back up, consequent encouragement. You want to see the lower half be used for entries, and once we leave it, the upper half stay untouched. And that's exactly what you're seeing here. And then our market's traded down into sell side liquidity there. So now we take this and we couple it with this low. And we dim this one. It's on your chart still, Caleb. It'll be in the chart, but just I'm not trying to draw too much emphasis on it now. It's just for you to be able to have it in your notes by screenshotting it. Only today's stuff, son. Tomorrow you're going to have to do your own charts. Okay, so we're going to see this expand down. We don't want to see it come back up into this inefficiency up here. It's in this box shaded area. Opening range gap. We're going to take that out for now. You can see the inversion fair value gap there. And we want to see speed here. Aggressively run down and take that sell side. Yes. Every single time it moves. Okay, Dow. We're almost in that fair value gap. This one's so dirty, it's probably going to want to unsettle these highs up here. So that's more like where I would expect them to take the Dow, because Dow just broke lower rate from the opening. Challenging market today for folks out there that aren't looking at the things I'm teaching you. That's an invitation to show me your trades, by the way, for the folks that like to troll me. Show me your Elliott wave today. Show me your knickknacks, your paddywhacks. Give a dog a bone. NQT2024. What are characteristics of high resistance liquidity run profiles? Deeper retracements than you want to see. Targets get traded to later than you want to see them traded to. Smaller inefficiency there. 3 up close candles. Change in state deliveries, that opening price there. That would be like the last line in the sand for me. I wouldn't want to have anything else go higher than that. Like I said, I don't want to see them come back to that first presented fair value gap. To do that is problematic for being short in the first hour trading. And we are basically technically ending that in 15 seconds. So. Time together. So in quick summary, I'll try to do this in 1 minute. We looked at how the market presented reasons why I believe that we still could very well be down here. I think that will still be a factor for this week. They left this sell side in place. They went back inside of the new week opening gap, which are these 2 purple dashed lines in here. And we're back inside of the first presented fair value gap. Caleb, you would not use this as your short. Here, yes. There again, no. What is it doing? It's returning back to your point of interest. If it's going back there twice, it's not as good as you want it to be. And you want it to react the first time you get into it. and then displaced lower. It did go to our sell side. It got close to the next one here, but then said, no, I'm not going there, and started pulling back up. And I told you I did not want to see it return back to the first percent of fair value gap. I didn't want to see it go back to the low of this imbalance here. So because it was going to go here, it's going to go back to the first percent of fair value gap, and or inside what? New week opening gap. So if it's going back there, that's fine. It's going to do so without you. So your trade would be entering here at consequent encroachment of your first percent of fair value gap. That's going to be inversion. Also keying up on the new week opening gap, laying over top of that, and your target would be these relative equal lows. You take a large portion off if you were inclined to have more than one. You don't have more than one contract now, but in your notes, you're going to say this would be first partial or majority of your trade-off. Why? Because you're in a decoupled market. And then your next target would be here, which did not pan out, so you would be stopped out going back into the first percent of fair value gap. So you're only going to be able to annotate with the basis of this being your profit taken, and you watched as much as this deliver, but that next level didn't give it to you. And it went back to what you heard Dad say, I don't want to see it come back and touch this inefficiencies low here or the first percent of fair value gap again. I don't want to see that. To do that doesn't afford you enough time to trade in that first 1 hour trading. So you have to stick to the rules. Even if this does roll over, you have to have rules, son. You have to have a basis to stick within and say, this is the guidelines I'm staying inside of.